Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Dear viewers, I was recently asked why the stock of Zomato has been witnessing correction despite making exciting investments in quick e-commerce. The management has explicitly stated that they want to continue making minority investments in other businesses with a special focus on quick e-commerce. Does the stock deserve better valuations because of such investments, some of which may create huge optionality in the business? Well, before I answer that, let us first understand what optionality is. Optionality is generated from an investment which has the potential to give huge returns, but the quantum of it cannot be ascertained. One can arrive at a fair value only over a period of time. Not to mention that such investments come with their fair share of risks, and if the bets do not play out as expected, it can lead to losses and poor capital allocation. It makes sense for a company to experiment with optionality when the core business is strong and it can afford to take calculated risks with finite losses and potentially disproportionate payoffs. Infoedge, for instance, has witnessed windfall gains from investing in Zomato and Policybazaar at an early stage, and it has made a string of investments in other ventures too, as you can see on the slide. Zomato, however, is yet to prove itself in the core business, especially as far as sustainability and visibility on profits is concerned. At this juncture, its investments in untested segments, for instance quick commerce, where the execution is even more challenging, warrants more caution than optimism. In fact, with the existing financials and cash burn in the core businesses, it falls in the realm of speculative investment. By the way, Infoedge is not the only one with huge optionality advantage. IndiaMart is another such player with a strong core business. On the slide, you can see a list of investments it has made. Unlike Zomato, IndiaMart has proved itself in the core business of B2B commerce. The company enjoys a 60% market share, has a debt-free balance sheet, very healthy profit margins and return ratios, and positive operating cash flows. Other examples in large cap space where the optionality offers a huge comfort include Infosys, Hero MotoCorp, and HDFC Bank. The slide here shows notable deals made by HDFC Bank. As per Crunchbase, HDFC Bank has made 20 investments, most recent being in Stockel in September 21. Stockel is a global investing platform helping investors from India and Middle East invest in the US listed firms. It has also invested in Smallcase, a fintech startup. Smallcase offers a platform that allows retail investors to invest in model portfolios of stocks, exchange-traded funds, and REITs. Its other notable investments include Who Sports, Peelworks, Furlenco, Virtuoso Infotech, Laltain, Cardeco, and Reliance Jio. A lot of these are platform-based businesses. In the past, its notable exits include Team Lease Services and Bandhan Bank. HDFC Limited too seems to be following the example of HDFC Bank. Along with IBCAM, it has launched Innovation to collaborate with startups on innovations in lending and finance industry. Key focus areas include property assessment for mortgage loans and customer servicing. The next on the list is Infosys. Infosys has an innovation fund invested in different entities that are leading enterprises in data and information extraction, drones, air quality, performance optimization system for professional sports teams, and an India-focused VC firm. Infosys inorganic investments include investments in product design and customer experience innovator, Salesforce consulting partner, leaders in next-gen digital services, and a JV with Temasek Holdings. Electric vehicles is perhaps one of the biggest megatrend in this decade, and many companies, big and small, want a part of it through stakes in EV startups. For instance, Hero MotoCorp's first investment in Ather Energy, a Bangalore-based EV startup, happened in October 2016, and the entity is now planning to get listed in 2 years. In the listed small cap space, some names that have ventured into EV space through such acquisitions and incubations include Minda Corporation and Carbon Extrusion Technique. Minda Corporation is an auto ancillary firm that has taken 26% stake in EVQ Point, an EV charging solution startup. Carbon Extrusion Technique is the largest manufacturer of plastic extrusion machinery in India, and it has ventured into EV space as well with Betrix. Betrix focuses on EV battery technology and green energy space. It has already received orders from the electric two-wheeler makers for battery packs and has announced further raising of Rs 3 billion for expansion of this future technologies brand. Other companies in the mid and small cap space that could benefit from optionality bets include BSE Limited, Cosmo Films, and the Hanuka Agritech. BSE Limited, apart from being a stock exchange, has successfully incubated Star MF platform, which is like the UPI of mutual fund industry, with over 2 lakh agents distributing mutual funds on it. Star MF is already highly profitable. Plus, BSE has been actively navigating new waters by getting into streams like IPO distribution, SME platform, bond distribution, commercial paper distribution, insurance distribution with ABEX of the US, and PAR exchange. Dhanuka Agritech is another firm in small cap space making tech bets to supplement its core business of agrochemicals. It has invested in Iotech World Aviation, which makes drones by the name of Agribot. The technology has good potential application in agriculture space. And then there is Cosmo Films. This flexible packaging player has launched a pet care division under the brand name Ziggly. Pet care is an underpenetrated industry in India, growing at over 25% CAGR. The company started with a pilot project that has performed better than expectations, and now the company is planning to roll out its digital-first omni-channel business model, which will include both digital and offline model. Cosmo plans to demerge this into a separate company later on. So these were some examples in listed space on companies that could benefit from optionality. Please note that the information shared in this video should not be taken as a view on the stock or recommendation. Nonetheless, these are some interesting developments to track. Now, before I end this video, remember that for playing on optionality, you should look for non-linear payoffs with investments in a business that can afford to lose without going under. By nature, the quantum of gains, if at all, is uncertain. So you must ensure strength in the core business instead of blindly chasing companies that are in news for making investments that just sound exciting. If you found this information useful, press the like button and share the video link. Further, I would look forward to your comments and feedback below the video. Lastly, for more such updates, do subscribe to Equitymaster YouTube channel. Thank you and goodbye.